Your taxable account might be the most flexible tool in your retirement toolbox. Use it well and it could save you tens of thousands in taxes. Use it poorly and you can waste one of the biggest planning opportunities. In this video, I'm going to break down exactly when and why to use your taxable account and when to leave it alone. One of the most common mistakes I see with taxable accounts in retirement is simply misunderstanding their role over time. These accounts don't serve just one purpose. They have different uses in different phases of retirement. And that's where things can get a little bit confusing. People start wondering, should I use my taxable account early, or am I better off saving it for later in retirement? That kind of question leads to what I'll call the prioritization dilemma. Essentially, which use of the taxable account takes precedent? The good news is this isn't as murky as it seems. In most cases, the prioritization is chronological. The timing of your need often dictates the value. In other words, when a taxable account is useful early in retirement, that use often outweighs the hypothetical benefits of saving it for later. Some of you will lean heavily on your taxable account in those first few years and completely exhaust that account. And that's just not okay, it's smart. Others will have taxable accounts large enough to draw them down consistently across all retirement phases. That's great too. The key is knowing when it adds the most value, and that's exactly what we're going to talk through in today's video. The value of a taxable account best shines in what I'll label as early retirement. One of the clearest and most valuable uses for a taxable account is for retirees under age 59 and a half who need liquidity. Retirement accounts like IRAs and 401ks are excellent for tax-preferred growth, but they come with a catch. They're not easily accessible before age 59 and a half without triggering some penalties. Sure, there are exceptions like Roth conversion laddering 5 years prior to retirement, the rule of 55 for 401ks, or 72T distributions from IRAs. But those strategies come with some strings attached and can lock you into rigid withdrawal schedules or employee-specific rules. A taxable account, by contrast, is completely liquid. You can access it anytime without penalty. That makes it the go-to funding source for early retirees. Take the example on the screen, a 54-year-old retiree with over $500,000 in a taxable account and a $95,000 annual spending need. They face a 5.5-year income gap before retirement accounts become fully accessible. In this case, the taxable account isn't just helpful, it's essential. Without it, their retirement timeline would be delayed or they'd be forced into less flexible strategies like 72T distributions. If a retiree is facing this situation, they shouldn't worry about later or better use for that taxable account unless they're very comfortable with delaying retirement. Another powerful use of a taxable account, again in early retirement, is qualifying for Affordable Care Act subsidies. Many retirees rely on the public marketplace for health insurance prior to age 65. And here's what most people don't immediately realize. What you pay for insurance has far less to do with your wealth and far more to do with what's called your reported income. Let me show you what I mean. On the screen, you'll see two identical couples in Texas, both purchasing the same healthcare plan. The only difference, one reports a very low income and the other reports a fairly high income. The result, a swing of thousands of dollars per month in premiums. That's because marketplace subsidy is based on something I'll call reported income. Not how much you spend, but how much income shows up on your tax return. Keep that number low and your premiums drop dramatically. Push it too high and you lose that subsidy altogether. As of 2025, the system is fairly generous. You can have a six-figure income and still qualify for help. But in 2026, the subsidy rules tighten. For a married couple, report income above roughly $80,000 and you lose that subsidy entirely. So here's the big planning question. How do you support a high standard of living while reporting a very low income? That's where the taxable account comes in. Most income sources, IRA withdrawals, Social Security, pensions, annuities, count dollar for dollar against your subsidy eligibility. Even Roth conversions count. Roth IRA withdrawals, on the other hand, don't count at all. But burning through your Roth early in retirement can be quite short-sighted. Enter the taxable account. Withdrawals from this account only partially count. Specifically, only the capital gains portion hits your reported income. So if you sell a $100,000 position and $25,000 of that is gains, only that $25,000 is included in that subsidy calculation. Now imagine a retiree who needs $105,000 to live on. If they take withdrawals from wherever is convenient and file for Social Security at 62, their reported income could easily exceed that subsidy threshold, costing them thousands in unnecessary premiums. But with a strategic approach, pulling mostly from a taxable account, managing gains, and ideally even delaying Social Security, They could get the same spending power but dramatically reduce that reported income, thus maximizing their healthcare subsidy. Use number 3 for your taxable account, especially in early to mid-retirement, is supporting a Roth conversion strategy. Specifically, taxable accounts can play a critical role in maximizing the value of your Roth conversions by giving you a smart way to pay the taxes. Let's break this down. Say you're doing a $100,000 Roth conversion and it triggers $20,000 in taxes. The default and most common approach is simply to withhold that $20,000 directly from the conversion itself. So $80,000 enters your Roth IRA and $20,000 goes to the IRS. It's easy, but it's also a little bit inefficient. You've just reduced the amount going into your tax-free Roth account, and over time that means a lot less tax-free growth. Now imagine instead that you pay the tax from your taxable account. Even if that means selling some assets and realizing some capital gains, you free up the full $100,000 to go into your Roth, giving you more tax-free compounding in the future. Plus, remember, taxable accounts are inherently less efficient. Dividends, interest, and capital gains all trigger taxes on an ongoing basis. So by drawing down this quote-unquote leaky bucket to pay taxes today, you're effectively trading a slower growing taxable asset for a faster growing tax-free one. But it gets even better. Paying taxes from your taxable account doesn't just make your conversions more efficient, it can also justify paying a higher tax rate on those conversions. Here's what I mean. Let's say you're converting $100,000 at a 22% tax rate and you happen to have $22,000 in cash sitting in your taxable account. Now, you could invest that cash and let it grow within the taxable account, but here's the problem. You'll be paying taxes on dividends and interest every year, and eventually when you withdraw that money out, you'll owe capital gains on the later use of that money. In a hypothetical 20-year example, the cash grows, but only to about $377,000 after all taxes. Now take that same $22,000 and use it to pay Roth conversion taxes instead. That full $100,000 goes into your Roth, where all of that growth is tax-free. In this case, your total after-tax wealth grows to nearly $387,000. So even though you paid the same tax rate using the taxable account to cover it, gave you more wealth at the end. That means you could actually afford to pay a slightly higher rate on that Roth conversion and still come out ahead, just by using your taxable account strategically. Bottom line, don't just think of your taxable account as a spending tool, think of it as fuel for bigger, more efficient Roth conversions as well. Now, we've covered the most powerful ways to use a taxable account in early retirement, but what about when you enter a more stable, steady state phase? Now, when I say steady state, I mean you've handled some of the big tax problems that are looming in the future, like RMD issues, and now you're focused on drawing income efficiently year to year, minimizing taxes while maintaining your lifestyle. Let's walk through how a taxable account can help in this phase by looking at a detailed tax map. Here's our example. A retired couple in North Carolina, they've already filed for Social Security and are receiving about $60,000 in combined benefits annually. To support their lifestyle, they need $110,000 in total income. Their traditional IRA balances are in a good place. There's no big tax traps coming down the road. Now on the screen, you'll see their annual tax graph. Social Security is already baked in the background. That leaves about $50,000 that they need to pull from some other place. One option, they could pull all of that $50,000 from their traditional IRAs. That's simple, but again, it'll be inefficient. The first $21,000 would be tax-free thanks to the standard deduction, but beyond that, things get quite messy. This couple enters a zone of elevated tax rates, not just because of ordinary income brackets, but the dreaded Social Security tax torpedo, which increases the marginal cost of each dollar withdrawn. On top of that, North Carolina state taxes apply here as well. In this phase of retirement, tax-efficient withdrawals are the name of the game. So here's the better approach. First, we do want to use the initial space within our tax graph, about $21,000 in IRA withdrawals, which will fall underneath the standard deduction and be tax-free. No reason to waste that bracket. But beyond that point where tax rates jump from 18.5% up to 26.5%, we pivot to the taxable account. Now let's look at the next tax graph. We've added that $21,000 withdrawal from the IRAs to this tax graph. The couple still needs about $30,000 more to meet their income goal. Here's where our capital gains strategies come into play. Technically, they're still in the 0% capital gains bracket, but here's the catch. Additional capital gains can trigger more of their Social Security benefits becoming taxable. So while capital gains are taxed at 0%, the side effect is a modest increase in their total tax bill. That said, if they're drawing from positions with a fairly high cost basis, meaning low capital gains, the impact is quite minimal. Even with some Social Security inclusion, their total tax bill, including state taxes, is just around $2,000 on $105,000 worth of income, which is incredibly efficient. Unless you're leaning heavily on Roth assets, you'll be hard-pressed to find a more tax-efficient withdrawal strategy. So in the mid-retirement phase, your taxable account becomes a strategic bridge, helping you thread the needle between income needs and tax efficiency. The key takeaway: know when to switch accounts as tax costs rise. Coordinating withdrawals between IRAs and taxable accounts gives you control, flexibility, and as we can see, meaningful tax savings year after year. Finally, let's talk about the role of your taxable account later in life, when you may be thinking more about preservation and legacy than personal withdrawals. If you maintain a taxable account through the end of life, there's a powerful tax opportunity you might want to think about preserving: the step up in basis. Here's how it works. Imagine you have a taxable account worth $1 million, but your cost basis is just $200,000. If you sell that account during your lifetime, you could owe, let's just say, 15% in capital gains tax on that $800,000, meaning a $120,000 tax bill. But if you hold that account until death, your heirs receive a step up in basis. The cost basis resets to the account's market value at the time of death. So in this example, your heirs could receive the full $1 million and pay nothing in capital gains tax. That's not deferral, it's a complete elimination of that tax bill. Now, this is a rare loophole in the tax code and it's extremely valuable. That said, this shouldn't be your sole strategy for managing your taxable account, especially when we consider early phases of retirement. In fact, I've never come across a case where preserving their taxable account solely for the step up in basis was the optimal move when comparing it to early retirement. Why? Because the benefits of using your taxable account early, whether it's to qualify for ACA subsidies, fund tax-efficient Roth conversions, or bridge to age 59 and a half, often far outweigh the potential tax savings from a step up in basis down the road. Not to mention, taxable accounts are less efficient over time. Dividends and interest keep ongoing tax drags, which slows growth. And if that tax drag reduces the size of that account over decades, that future step up might not be worth what you think it is right now. So yes, step up in basis is a powerful tool, but it's one piece of a much bigger puzzle. The best outcomes come from using your taxable account strategically at each stage of retirement, not just preserving it for a potential windfall that may or may not materialize. Hopefully this gave you some fresh insight into how and when to use your taxable account in retirement. If you found this helpful and want to see a similar deep dive on traditional IRAs or Roth accounts, let me know in the comments below. I'd be glad to create those. And if you're curious why your taxable account tends to grow more slowly than your other retirement accounts, I've got a separate video that breaks down exactly this. I cover the 2 key reasons your taxable account can be your worst performing asset over time. You can check that out right here. Now, thanks for watching, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.